extrudes it through or filters it through a scientific lens. Like the classic non-scientific historian says this happened and that was suboptimal.
Right.
And the history of science historian says that happened because of this, that happened because of this. Guns, germs, and steel, right? The Europeans didn't just show up to the New World and then they conquered it. They showed up to the New World, brought a germ, and everybody died.
Right.
They didn't have to conquer it.
Right.
Like 95% of the natives died, and that's actually a biological explanation for what happened. If you don't understand, the science of immunology, or you don't understand germs, you couldn't explain it.
Right.
And then, if you think about the impact of steel, what's it take to create steel and explosives and gunpowder, and so the history of science is all about how technology dynamics channeled the course of human history. And I think the reason it's important to Bitcoin is you can't really understand Bitcoin if you're not an engineer. If you don't understand engineering, systems engineering, control systems, servo mechanisms, system stability, you've got to understand all those concepts intuitively. If you don't understand thermodynamics, the people that are pure computer scientists who are weak on physics and engineering and systems, oftentimes they create Rube Goldberg devices in code that a hardcore engineer wouldn't build, right? And so you can't just be a coder. And of course, if you're a pure engineer and you reduce the world to I built a ship or I built a gun, but you don't consider the implication of the ships and the guns on the course of economic and political history,
right,
then you don't really understand Bitcoin either, because you have to understand the history of money and the history of economics and mercantile networks. And the idea credit networks are local. Like a German prince can have a credit network, a British prince can have a credit network, but gold or silver networks tend to be transnational, right? That the French, the Germans, the Brits, the Persians, and the Chinese could all agree to trade on a silver network or a gold network, but not on a Chinese paper money network. And so when you start to understand the impact of technology, that's metallic money on economic networks, and then the impact of a ship with guns on it, on that economic network, or the impact of not having immunity to all the germs the Europeans brought, or the impact of not having steel and being stuck in the Stone Age. All of those things have an impact on the way the world evolved, and I think Bitcoin it's crossing every one of those fields right now.
Right. Yeah, so being able to synthesize that information and understand the cause and effect, and then looking at the changes today, as you said, sort of a multinational asset, strong as steel, fast, et cetera, then you can it seems like you can start to see maybe the future that creates better than most people.
Well, I think if you've got a broad synthetic educational background, if you've studied a bunch of different subjects, had a lot of experience, you appreciate Bitcoin more. If you have a very narrow background, if you understand economics, if you studied economics but never studied engineering, you'd be missing half the equation. And if you're an engineer that doesn't understand economics and never been in business or never traded internationally or never traveled, or didn't know anything about history, you would also understand only a part of the equation. So I just think you need to know a lot of different subjects in order to fully appreciate the impact and the significance of the invention of Bitcoin.
Yeah, which is then in your professional career building technology companies. And so you kind of predicted a lot of these technology companies that have grown in some of your books that you wrote in the past, but then also navigating those tech companies through the capital markets then sort of gives you a new perspective to see the deficiencies in the current capital markets that we have today, and then help you kind of think about fixing those with jumping into sort of like this refinery model, trying to solve some of the deficiencies in those capital markets, the way companies accrue capital.
Yeah, I think what can be said of the capital markets is 99.9% of the companies are locked out of them. Right, so the first question you got to ask is, how come there's 40 million businesses in the United States, but there's only like 4,000 publicly traded companies?
Right. So don't have access to the capital.
Okay, so it doesn't sound like like if I said only 4,000 companies have telephone and internet access and the other 40 million businesses don't, what would you say?
Yeah, that'd be a problem.
Yeah, what if I said 4,000 companies have bank accounts and the other 40 million don't?
Right.
So you just start with the observation that the capital markets can't be all that effective if 99.99% of the companies can't access them.
Right.
And beyond that, the other observation is if you look at the companies that are in the public market, if you look at the thousands of publicly traded companies, it's like 20 that control all the attention.
Right.
And most public companies are zombie companies. They're uninteresting. No one cares about them. They carry a huge burden of regulatory compliance. And they don't get the attention they deserve. So one could characterize the capital markets as being unwieldy, ineffective, right? And it's, and what is that? They're 20th century instruments that never really evolved in the 21st century. You got to ask the question, why does it take 3 years to raise money? If you have a small business, why can't you do it in 3 days?
Right.
Why does it, why is it impossible to take custody of your own stock shares? Why is it impossible to trade shares on Saturday afternoon?
Right.
Why is it impossible to transfer things globally? Why is it that you can actually take $1 million of cash and get paid interest on it, but you can't take $1 million worth of stock shares and get paid for that? So there are all these things that just are very inefficient that we just take for granted, but they don't work very well.
Right. A lot of that is technology being inefficient, and here we're at this in DC at this Bitcoin policy event, and a lot of that might also be regulatory, right? So a lot of that regulations maybe prevent some of that.
Yeah, generally, oftentimes, whenever you have a highly regulated industry, progression stops.
Right.
The banking, if you look at the credit markets, they seem to be stuck they're stuck in a mode that was probably modern 30 years ago. Like they're 30, 40 years old, and they haven't advanced. If you look at the equity markets, it's the same way. For example, my company came public in 1998. We traded on NASDAQ from 9:30 in the morning till 4 in the afternoon. The year is 2025. We trade on NASDAQ from 9:30 in the morning till 4 in the afternoon.
Right.
What's the difference between the way my stock trades today and the way it traded 27 years ago?
Yeah.
Nothing.
Yeah.
Right. Could you imagine any other industry where there was no...
7 years ago, you didn't have trading apps on your phone, and now it's even more accessible, but yet the market is still held back, even though retail could access it easier.
Yeah, because, the traditional finance industry is highly regulated, and it has settled into a comfort zone. And, the forces of progression are in the crypto industry. Most of the forces of the traditional finance industry are forces of regression. Like the knee-jerk reaction is, why shouldn't we do this? Why is this a bad idea? If you listen to all the Gensler speeches for the last 4 years, it's always why this is a bad idea.
Right.
Like, why can't I issue a token, for my small business over the weekend? Well, we got to protect the investors.
Right.
Okay, so that's why we're going to disenfranchise 40 million companies from being able to raise money, because the people that might want to invest in them might not be qualified to make that investment. So it's kind of like, well, why don't we give cars to people below the age of 60? We've got to protect the pedestrians. Right. Or protect the, it's like if you took that rule and you applied it to phones or cars or websites or flying in an airplane, we would have no automotive industry, we'd have no aircraft industry.
Right.
We'd have no telephones. We'd have nothing, because we wouldn't do anything until we were sure that no one would be harmed by the doing of the thing.
Which is impossible.
We wouldn't even have fire. We wouldn't want someone to get burned. We wouldn't have electricity. People might get shocked.
Right.
Got to protect
Yeah.
got to protect the people that might get hurt by the new idea.
Yeah.
So that's pretty much the existing status quo in traditional finance, and it has been for 30 years.
Yeah. And with the advancements of technology, I want to get more into the politics side, and you talked earlier on your keynote about maybe the last 12 months of this big political winds that shifted. But kind of sticking with some of the ways that technology is changing, on your keynote you said you spent, I think, about 30 years trying to come up with $1 billion idea, which you did, and then couldn't come up with the next one, and now half a dozen billion dollar ideas in the last year or two. And that's sort of, in New York at the Unconference, you talked about this refinery model and Standard Oil sort of taking this raw asset like Bitcoin and creating products off of it. And so you're creating now products off of it. That's the model to do this. What would be the kerosene of this industry?
Kerosene represents most highly refined crude oil. It's pure liquid energy, right? It's jet fuel. You put it in rockets. You can't refine oil more than kerosene. So it's an important metaphor. It's the cleanest, highest grade distilled liquid energy, like pure grain alcohol, right? That's what you're talking about there, from a bunch of potatoes, stack of potatoes, and out comes pure grain alcohol. Right. The equivalent of kerosene in the Bitcoin industry is a treasury preferred credit instrument like Stretch. So on one side, you have digital capital, Bitcoin, and Bitcoin is a long duration, volatile, high energy, high performance source of capital. Long duration, think of it in terms of 240 months, 20 years. If you want to get the optimal performance, you're going to hold it for 20 years. It's a 10 to 20 year type investment.
Right.
High volatility, right now it's about 45 vol. Implied vol, it's been 50, it's been 60, it's been 70 vol. And high performance, appreciating 50% a year.
Right.
So that's the raw commodity. What happens if I strip away the volatility, strip away the risk, strip away or compress the duration, translate it to a given currency and extract the yield? Right? That's what a treasury credit instrument or treasury preferred is. So that's what Stretch is. The idea is you build something that's got 1 month. I'm going to give you 10% dividend yield for 1 month. The duration is 1.
Yeah.
The yield is 10%. The currency base is US dollars.
Right.
The spread is if the risk-free rate is 400 basis points, and that's a 6%, 600 basis point credit spread. I've extracted a 600 basis point spread for the next month in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x raw Bitcoin is 1 to 1. It's if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money.
Right.
But if I 10x over collateralize something, I have $10 of Bitcoin, I have $1 of Stretch. If Bitcoin trades down 50%, I still got $1 of Stretch. If Bitcoin trades down 90%, I still have $1 of Stretch. The statistical odds of Bitcoin trading down 90% are point something, right? It's a small percentage. So by over collateralizing, you strip away the risk. By structuring it to adjust, if you put a set of adjustments or representations below par, below 100, you start to strip away the volatility on the downside. If, with Stretch, what we did is we put in a call option at 101, and then we told the market we're going to sell it actively at 100 or better.
Right.
And then we also told the market we're not going to sell it below 99. And if it's below 99, we're going to raise the dividend.
Right.
Okay, so you're kind of collaring this instrument. And then the last point is we created a preferred instrument where we pay it monthly in cash, and then we adjust the dividend every month. So it turns out if you scan in the history of preferred stocks or the history of the credit markets, no company has ever issued a preferred stock where the management has discretion to adjust the dividend every single month. Like there are some preferreds that are floaters where they set the credit spread at 350 basis points over SOFR and they will float with SOFR with the risk-free rate. And there are a lot that are fixed where you set it at 7% and the principal will trade up and down if SOFR falls or rises. But the idea that the credit spread is completely variable is a new idea. But by the way, not a new idea in the world of credit, because who does this? Well, nation states do it.
The Fed.
Literally, that's what a central bank does, right? That's what every central bank does. They set the interest rate on their currency. What we did was just copied, traditional bankers, and we set the interest rate on our currency, which is stretch. So that is the kerosene of the Bitcoin, treasury company, or of the digital assets industry, because it represents the greatest degree of financial engineering, just like kerosene represents the greatest degree of petroleum engineering, right? I've done the most refining. I've distilled the highest quality product. You could imagine, for example, you could extract the same product in yen. So I want to create a yen instrument that's 10,000 yen that pays, a monthly yen cash yield or a cash dividend. I change that every month. And now I've created the equivalent of kerosene for the Japanese market. And of course, what does everybody want? Everybody kind of just wants, I've got some money I need to park for the next 90 days. If I put it in the bank, in Japan, I get 50 basis points or less. I put it in the bank in Switzerland, I get minus 50 basis points. If I put it in the bank in Europe, I get 200 basis points or less. If I put it in the bank in the US, I get 400 basis points or less. And so what I'd like to do is put it in some kind of structure where I'm going to get my money back in 9 months or 6 months or whatever. The principal's not going to move around, but I'm going to get 10%.
Right.
Everybody wants a bank account that pays 10% instead of 4% or 2% or 0%. And so I think the most interesting product that you can create, the most interesting digital credit product, is a treasury preferred credit instrument for corporate treasurers or for retirees, right? And how big is that market? It's like $30 trillion in the US.
Yeah. Of
just short-term treasury money. So 30 trillion in the US that's getting paid SOFR.
Yeah.
And the opportunity with digital credit is you create a company, you hold Bitcoin, that's digital capital, you start to issue credit instruments on top of the capital, and you can decide how much risk do you want to strip away. Is it a BTC rating of 2, which is 2 times over collateralized, or is it 10? Right? 2 is less risk stripped away, 10 is more risk stripped away. Strip away the amount of risk you want, strip away the amount of volatility. The smaller the instrument compared to the overall collateral pool, the less the volatility, and then there are a lot of terms and conditions that you can put in the instrument that would constrain the volatility. So you decide how much volatility and risk you want to strip away, you decide how much yield you want to give it, you decide whether you want it to be in pounds or Canadian or euros or yen or whatever, and then you distill out, you extrude the yield and the pure, boost over the risk-free rate, and you offer that to the marketplace.
Yeah. I saw you ask it both at New York on conference and then today at the keynote. Just let me see a raise of hands, like how many people have a bank account that like 10%? And of course, everybody wants that, so we can see the demand for that is...
Nobody in the world is getting paid 5.
Right.
We created a product, STRD, Stride. It's the junior long duration credit instrument. Right now it pays about 12.6%. 12.6%, and so the average, by 12.6% as a return of capital, so it's tax deferred. And if you put your money in the bank, you're going to get 4% pre-tax, 3% after tax.
Right.
So it pays anywhere from 3 to 4 times as much cash flow.
Yeah.
So those are really interesting products that we're creating in the market.
Yeah, I mean, just in the U.S., we have $7 trillion sitting in money market accounts, just trying to earn a third of that yield that you're paying out there. And so then you have 4 different products, and so not everybody wants kerosene. Some people might want other products.
Yeah.
And you've got Strike, Strife, Stride, and now Stretch. And so each one of those sits in a different location that gives them a little bit of a different variation of the kerosene.
Yeah. Pure kerosene, like I would say the other ones are kind of like gasoline or diesel or plastic or or naphtha or so. There's a lot of other petrochemicals. The entire petroleum industry is fascinating because out of a barrel of oil doesn't just come gasoline, diesel, and jet fuel. Also, you get acrylics, you get fibers, you get polyester, you get lycra, you get PVC, you get the stuff that we make doors with it, we make walls with it, we make pipes with it, we wear it, we look through it, we burn it. Think about how profound it is. Like just around this room, if you glanced at the room, you'd probably find there's probably 100 or hundreds of petrochemical products in this room that have been created. So the possibilities are endless, but if you come back to just what we've done, right? We're just one company and we're showing what's possible. Strike was the first, and it is a convertible preferred. So Strike shows how you can extract any amount of yield, delta, duration, risk, or volatility. So with Strike, we basically gave it about 35 delta. That is like 35% of the upside of the equity. So you get an equity component, then you get like right now it's like 8.5% yielding, like it pays 8% at par. Yeah. So we gave it a dividend at 8%. We gave it an equity component for some upside. And then we made it cumulative, and so gave it some seniority privileges. And that's for people that kind of they don't want to buy Bitcoin and be on the roller coaster. They want to I call it a Bitcoin fellowship. It's like, it's like you buy it, you're waiting for the upside, and you're getting paid a living stipend.
Right.
While you're waiting.
Yeah.
For the principal to appreciate. So that's one instrument.
Because it will convert into MSTR at 1,000.
Because it's got a conversion rate, right? So if you want to hold something for 30 years, well, you're going to get 30 years worth of dividends, and at the end of 30 years, you're holding, say, for $100 stock, you're holding if you have one of these, you've got a $40 worth of equity when you buy the $100 instrument. So that's for people that want some upside with downside protection, with guaranteed cash flow, right? Which a lot of investors want, right? I mean, a lot of investors, if they wanted max upside, max volatility, you would buy the Bitcoin, right? Right. But can I go 30 years without any cash flow? Right. Can I go 10 years without cash flow?
And can I stomach the volatility?
Yeah, and there are a lot of people that just don't want the volatility, right, for any number of reasons. So that's Strike. It turns out that Strike is the most volatile of the 4 preferred instruments because it's got that equity component in it. Right. And it's got longer duration, and so that means it's got more volatility to interest rate forward curve, and it's got more volatility to Bitcoin price and more volatility to MSTR price. The second thing we did was Strife, STRF. And that was long duration senior credit. So it pays 10% dividend at par forever. And that means that, and it doesn't adjust. It's not a bond because it's a dividend. It's better than a bond because, if you want cash flow, because the dividends get better tax treatment. And if it becomes a return of capital, which is what it is right now, it's completely tax deferred. So that's for someone who's a long-term credit investor, and it happens to be senior in the capital structure. So it gets paid off before everything else, and it has penalty provisions if we ever skip a dividend, right? And so extremely risk-averse institutional investors that want the credit, but they want to be ahead of everybody else in the stack, they would buy that. Well, that's trading above par right now. So it pays like 9% effective yield, okay, because it's senior. we followed that with the identical instrument. We basically paid 10% at par, but instead of cumulative, we made it non-cumulative, and instead of senior, we made it junior, and instead of the penalty provisions, we took them out.
So get a little more yield,
And so what it does is it makes it theoretically riskier, to the person studying the contract, but it means it trades lower. So that trades like in the 80s. So that yields 12.5 or 12.6%.
Right.
So the issue is, why would somebody want to buy the one without all the investor protections and the security? And the answer is because you get paid 360 basis points.
Right.
So do you want 12.5 or 12.6% for the junior instrument, or do you want 9% to be senior? Right. Well, if Bitcoin, goes sideways or up, and if the company doesn't fail, then it's going to cost you 3.6% a year for the rest of your life to not trust us.
Right.
You see? So now you've actually got there an actual credit spread. If you're wondering, what is the equity premium between being senior and then having none of the representations? Well, you've actually got the market telling you it's like 3.6 or 3.7% or something. It varies every single day.
Yeah.
If you don't trust Bitcoin, if you think Bitcoin's going to zero, you wouldn't want to buy any of this, right?
Right.
And so then it comes down to, how much do you trust the company?
Right.
And if people buy dividend-bearing equities all the time. Like every single equity, if you buy Verizon equity, if you buy a telephone AT&T equity, they pay dividends. But they're not required to. They could suspend them without prejudice and without penalty at any time. So could Apple.
Right.
Do you trust the company? Right.
You know that if they suspend it, their stock's going to take a hit, but otherwise you're completely trusting it.
Your view is like, well, they probably won't because the stock will take a hit. And so the issue is, with Stride, will we pay the dividend? Well, of course we will, but what happens if we don't? Well, if we don't, Stride will trade way down.
Right.
But then we won't, and then you're like, well, why would the company care? It's like, we want to sell it.
Right.
Like if we actually default on that obligation, then the instrument isn't a capital raising vehicle for us. Yeah. And the big idea is, unlike most companies that issue credit apologetically in order to deal with a crisis, we issued credit strategically, enthusiastically, with the intent that the credit is the product. Yeah. You see, when Boeing issues preferred stock, the product is the airplane. They sold the preferred stock because they ran out of money to build airplanes. Yeah. We issue the preferred. The product is the preferred. We didn't never run out of money.
Right.
We issued, why did you sell $1 billion of Stride? So I could sell $10 billion more of Stride. Why did you sell $1 billion of Strife? So I could sell $10 billion more of Stripe. So we have a very different business model in that regard. We created the Stride so we could create the credit spread because we literally wanted to have an investment grade type instrument, a senior one, and we wanted to have a junior one because there's one class of investors that want the junk credit, like they want 12% yield, right? So it's very simple. Do you trust the company? Do you want 12.5%? Do you half trust the company and you prefer to take the 9%? Well, there's markets for both, and they are not the same investor.
Yeah.
There are days when everybody wants to buy Strife and they don't want Stride, and there are other days when they want to buy Stride. And so that was part of building out the risk curve. And then the last thing we did, Stretch, was a very different idea. Instead of paying an 8 or 10% perpetual dividend forever, we just said, hey, let's actually reduce this to 1 month duration, right? And so we're only promising to pay this dividend for a month. The other one is a promise for 100 years. And so theoretically, the Macaulay duration, the theoretical duration on the other instruments ends up being between 8 and 20 years or 8 and 15 years. It's very long range. Think of a lever that's 120 months to 240 months long, and you have a little change in interest rates, and that's a very big lever to the good or bad. But with Stretch, the idea was a 1 month duration. Of course, inherently, that's going to be less volatile. Right. And you're like, well, I'm not going to get capital appreciation. If SOFR dives by 400 basis points, I'm not going to double my money. Well, exactly. It's a treasury instrument. You're not buying it to double your money. If you wanted to double your money, if SOFR dives, you would buy Strife. Right? That's the instrument for the credit investor that wants to actually ride it up when interest rates fall or wants to do the opposite when interest rates rise. That's a different instrument. It turns out that most people, right, corporate treasurers, retirees, retail, most people, they're not really interested in being long duration credit investors.
Yeah.
Like ask the average person, do you have a bank account? Yes. Do you have a 30-year treasury bond? No. Like the difference is like 50 to 1. Stretch came last, but ironically, Stretch is the best piece of financial engineering, and it's probably the most universally applicable product because what you're doing is just giving people pure currency cash flow, pure currency yield without the volatility, the risk, the duration, or the delta. It's like, you know, some people want delta, like I want 30 or 40% of the upside of the common stock. Other people don't. Other people are like, I want nothing to do with the common stock. I just want you to pay me 10% on my money until I ask for my money back, right? That's what they want. It's a very different financial instrument for a different investor.
You mentioned how when Boeing issues debt, it's because they need the money. And when you do it, when Strategy does it, you're issuing the debt because that's the product. And we think about like, if I'm buying the debt of Boeing, then I'm trusting that their investment into their airline will have enough cash flow, maybe, to pay me in the future, versus I'm paying you, but you're buying the asset. So I'm not dependent on future cash flows because I know you have the asset and the debt is over collateralized.